office. Today we have launched our new office in Marol, and from today onwards we will start our services from Bombay also. Friends, this webinar which we are doing every Friday is a knowledge sharing from our part, and this is our efforts to give back to the society and especially for the professional and corporate. Because every week we are selecting some new topic and we are working out. So this time, this webinar is designed to provide valuable insight and help the participant to navigate the world of investing with confidence. Friends, as you are aware, the investor base is growing up. And in India, you have seen now 11 crore Demat account has opened. And if you compare with the last year, there is a increase of more than 3.5 crore. So you can understand the interest of the investor is increasing. So we thought that we should organize some program for the investor point of view also, because everywhere, everybody is not that perfect investor. So that's why today we have requested the people who are in the market, they know the subject, they have a money also, they have a deep research also. So today we want to organize this session with esteemed capital market expert, those who will share with their expertise on important factors that savvy investors should prioritize when seeking long-term financial growth and market-informed investment decision. By sharing their knowledge, strategy, and industry best practices, they will empower you to make a smarter investment choice. Friends, as you are aware that stock market is a device for the transferring money from the impatient to the patient. This is Warren Buffett quote. And you can understand when we talk about the patient, that patience mean that you are talking about the long term. So today we want to discuss identify promising sector and industry for long-term growth, evaluating company fundamentals and financial health indicators, understanding risk management techniques to mitigate potential pitfalls, analyzing market trends and forecasting future opportunities, unveiling in potential investment opportunity that align with one's long-term goal. I extend a very warm welcome to our chief guest and all the learned speakers to today's webinar. Our chief guest today is Mr. Mohit Bhatia. He is CEO, Bank of India Investment Manager Private Limited, and has a demonstrated history of working in the investment and management industry, is skilled in asset management, equities, capital market, investment advisory, and mutual funds. He is a strong marketing professional with an MBA focus in finance and marketing from Management Development Institute of Gurgaon. I welcome Mohit Bhatia ji for this program, and we will definitely get some new knowledge from you relating to the investing in capital market.
Thank you, Pawan ji. Thank you.
Welcome. Then we have our guest speaker, Mr. Alok Singh. He's a Chief Investment Officer, Bank of India, BOI Investment Manager Private Limited. He has more than 23 years experience in fund management, asset management, in managing third-party and proprietary money across asset class, including public equity, debt, private debt, high-yield credit. I welcome Alok ji. Your insight of the market and your experience as a fund manager will definitely enhance the knowledge of the participants, and including me also and all other speakers. I welcome you, Alok ji. Then we have Mr. Arun Malhotra, who has more than 27 years experience of capital market experience, having served in BLB Limited, DBS Capital Trust Securities, part of DBS Bank Singapore, to set up their Indian equity broking operation, managing at Napier, New York, and which is a US hedge fund in Bombay, whose performance was well over the benchmark indices throughout the various cycles. Since 2013, Arun is a consultant to a European investment bank and investing his own money in listed equity. He did his executive MBA from FMS Delhi and also full-time 2-year MBA and from Simon Business School, University, New York. I welcome Arun Malhotra for this program. You are an expert portfolio manager and you are a researcher. So we are expecting that something great and new identification, new area, and new advice to the investor will get.
Sure, Pawanji. Thank you.
Then I have Mr. Lalit Dua, he's a promoter director of CEO Rajasthan Global Securities Limited, which is India's largest special situation company. He has 27 years of experience in equity research and has been a visiting guest faculty at various forum and top colleges in the UK and US. He's also one of the leading advisor to various corporate and wide-ranging subjects such as corporate finance, mergers, takeover, and restructuring. And interestingly, he is one of the largest special situation fund management company, Rajasthan Global. And I hope that Lalit Dua will give a new dimension to various aspects of investing. Friends, before starting this session, I just want to, because this is a topic for long-term growth of the investor, I just want to discuss this, what in small investors or what the majority investors, they are doing mistake. So I identified that one is lack of research, emotional investing. I think here our Mr. Mohit Bhatia, who's expert on behavioral investing and things, will discuss more on this. Then lack of diversification from the investor side, then short-term focus. These are some mistakes. Then question is that what is the solution for this? So education and research, emphasize on rational decision making, promote diversification, and focus on long term. So if you see every book on the stock market investing, and I have just quoted Warren Buffett, everybody is saying a stock market is not a place for a small time. It's a long-term growth plan. If you have, then you invest in the market. So the question is, what is my solid investment plan? Which should I make? So the expert is always saying, define your financial goal. You should not blindly invest. You should make that I have to buy this house, I have to buy this car, I have to buy something, or I have to do something. So if you are making a financial goal, then you will reach to that level. You can take advantage of this. Otherwise, you will be confusing and you are just doing investing as a plain vanilla. Assess your risk tolerance. Sometimes what is happening, somebody is very conservative, somebody is very aggressive, and somebody aggressive is there, but he can tolerate the risk. So that you have to see from your own source. Asset allocation, that is another very important aspect, that you should not put all eggs in one basket. You should divide not only these stocks, but multiple stocks, multiple industry, and then not only on stock, but bonds, cash, and alternative investment and debt. That is the asset allocation you should do. Investment selection will be based on not on the hearsay, but it should be on the basis of some research. Regular contribution and automatic investing. It's not that you invest and forget. You should invest and regularly watch. Sometimes the big good company can also bust also. Monitoring and rebalancing. Sometimes you have to do this. Change your portfolio, change and more doing. And stay informed. That is the most important thing. You should know what is happening. A good company is today, tomorrow it can be a zero company also, if you're not doing the aggressive study and doing the market analysis. So friends, these are some few points, because I have also worked, me and Arun was there in BLV. We have worked 10 years, 12 years in the stock market. We have seen how investors are investing. They are on the basis of impulsive purchase, sale. And invest, and as you are aware, the stock market is a game of fear and greed. And in the fear and greed, you cannot control anything. Emotional investing will come, and your hearsay will come, your tips will come. So today we will discuss all these issues. So first, I will request our chief guest, Mr. Mohit, because he is a person who is uh, in investment, who has a knowledge of behavioral issues related to investors, and I'll request him that he can cover the macro aspects of investment. That is the first part. And friends, as you are aware, that we are organizing our webinar every week on Friday, 4 to 6. So because when we are announcing at the last, so many people are not getting information. So I'm just announcing the next webinar will be on family trust for wealth. For our program will be on family trust, an effective tool for succession planning. And we'll discuss all aspects of listed entity, tax aspects, aspects relating to the various regulatory things, and how it can be effective tool for your succession planning. We'll discuss this. So this is one announcement, and after that, I'll request Mr. Mohit to please share your thought. And after that, I'll request Mr. V.K. Agrawal, who is our in charge of webinars, which we are doing, and he will take care of this. So over to you, Mohit sir, and Agrawal ji, over to you.
Thank you very much, Pawanji, for inviting me here. So greetings to all the participants, and it's a pleasure and honor to be invited to this forum by Pawanji, who himself banking world. So I think you obviously are adding tremendous value to the industry. Thank you for that. Today also, I think, an interesting day to meet, because the market has touched another high, right? So we have the market experts here with us. We're going to talk about it. But interesting day to do this webinar, where I'm sure there'll be a lot of queries and questions from people, also participants, as to where the market is headed. But like Pawanji mentioned, I think there is a lot more to investing than just looking at the day-to-day movements. But prior to that, let me also congratulate Pawanji and his team of corporate professionals for organizing this. And I think this is the 136th webinar, I'm told. So I think please continue this good work. It adds, a very different perspective to investing and a holistic view of, the corporate world. So once again, greetings to all professionals and entrepreneurs who have joined this forum. And, thank you for inviting me here. So friends, for the topic this evening for this webinar is investing for the long-term growth. And we have, three eminent personalities with great experience in the markets, who will obviously share their deeper insights, investing frameworks, market outlook, and I'm sure as well as some of the nuances from their own experiences, which will make this truly a valuable and insightful, event for all of you. But before that, we begin and I hand over the proceedings to our esteemed panel. I thought, let me share a few of my learnings actually in the investing world. So of my 28 years of working, I've spent nearly about 24 years in the mutual fund industry, beginning on the equity research side, and then spending some time in the US, coming back, and since then I've been in the sales and marketing function. Worked with 4 different mutual fund houses, and have got the privilege to head this mutual fund, which is Bank of India Mutual Fund, 100% subsidiary of the 9th largest banking entity in the country, which is Bank of India. So in all these years, I thought it'll also be important for me to share some of these. I would say a lot of you may call it cliches, but I think the fundamental truths which really stand out. And like I said, we have the experts who will really give you the investing framework and the market outlook, and what sectors to really look at. But first and foremost, I've through my experience, through people I listen to, I think there's never been one single formula to make money, right? So if you're looking or hunting for one single formula, there's none. And Pawanji rightly pointed out, there's no free lunches. You will have to invest, gradually invest, watch your portfolios, review, But there is absolutely no single formula. You will need to kind of invest experience and customize these experiences for your own financial plan and requirements. Second, I think it's important to know the difference between savings and investment, right? So savings and investing, a lot of people confuse both to be the same. And while saving is usually setting aside, some of your resources for future, investing truly is, taking out some money from your current consumption and putting it aside for future consumption in a way that it is able to at least beat inflation. So in a way, it is trying to, help you attain a lifestyle when you are not running at the same pace as you are today. So that's investing, and it addresses the problem of inflation, which we think, given a country like ours where social security systems are still evolving, it will be very important to ensure that enough money goes into investing and not just saving. Um I think one more point I found interesting, it's never too late to start investing, whether in the stock markets, directly in equities, or through investment vehicles like mutual funds. But it is important to start early because, as Einstein pointed out, compounding is the eighth wonder of the world, and this can do magic to your investment. So I would think, I'm sure a lot of you are seasoned people, but for advice to anyone or everyone, I would think that simply putting aside at least 10% of whatever you earn, wherever you earn, whether it's a one-time bonus, salary, monthly income, whatever. I think putting aside at least 10%, उसके बाद बाकी चीजें सोचेंगे, but 10% putting aside for the long term will really help work wonders for your portfolio. Pawanji also mentioned about strategic asset allocation. I think an extremely important concept, and do it taking a holistic view of all your financial and physical assets. I think that's really important because a lot of people just look at having made money in certain stocks or certain investments, but forgetting a picture. End of the day, I think what all of us will need to be concerned about is how the net worth, how our net worth or individual net worth is rising year on year, and that's where a holistic view of your assets, liabilities, and therein planning your asset allocation or strategic asset allocation becomes really, really important. And one simple way of doing this is to really look at what is the kind of weighted return you are looking at, maybe 10, 15, 20 years from now, or from the time you start saving, and work backwards in terms of the mix of assets, of physical or financial assets that you want to kind of build up. Also, asset allocation, agar हमने कर लिया, it is not a fill it, shut it, and forget it kind of a proposition. I think what is also important is what is the security selection that goes into it. What is the quality of securities that you are purchasing? What are the costs? And most importantly, the time that your portfolio is going to spend in the market. So typically all empirical evidence shows that more time your money spent in the markets, there is a lesser chance of you losing the money and a much better chance of you of generating good long-term wealth. So while we do all this, it is also very important to ensure that and keep in mind that risk and return go hand in hand. So when you are looking for generating good returns or alpha, in our quest we forget that we also need to protect the downside, because this is an extremely important component. And I've seen a lot of people portfolios really lose value because of extremely risky bets. So keeping an eye on the drawdowns and ensuring that these are minimized is going to be important in terms of wealth creation, which means that keeping an eye on liquidity of investments that you make is extremely important, right? So while something which is very, very liquid like a bank account obviously will generate very little returns for you, but lesser the kind of liquidity, obviously there are chances that you will end up having a wider range of returns. But what I am implying here is that when you look at your overall portfolio, look at liquidity from the aspect of diversification and reducing your concentration and liquidity risk in your portfolio. So Those are a few things I thought I would take up with you in terms of some of these behavioral issues that come up when investors are investing in the markets. Uh, Again, it's very interesting times, like I said, and I will not uh, shy away from saying this, that we believe next 2 decades, and I'm sure all these experts here on the panel, the three of them and Pavanji, will probably elaborate on this and discuss this in more detail. But we truly believe, that the next 2 decades are, great times to be in the Indian equity markets, having had a background in the mutual fund industry mainly and in equity research. I may sound biased, but I think certainly if you are looking to invest and not just save, equities is a place that can really, help you generate returns which are beating inflation in a big way. India seems to be the center piece today, whether it's globally or even for the domestic investors. I can tell you from our systematic investment plan or SIP numbers that we keep on seeing growing month on month. At a time we used to be worried about FIs bringing in big money or taking out big money, but today I think domestic pillars like mutual fund SIPs, the money coming in from insurance companies, NPS, EPF, PF money and all coming in into passive funds. I think it's a big stability factor in the market. We also believe that this is obviously a convergence of fundamentals, technicals, and sentiments, and this truly provides a very benign atmosphere. In fact, a very promising environment for people who are looking at the long term. So you will see volatility, and like we mentioned, the topic here is creating wealth in the long term. To me, I think starting early, investing regularly, and reviewing periodically is the key today. Uh, Investing in the equity markets, I think, is going to be essential. This is not to again say that you should not invest in fixed income assets or alternates, but I think public markets today offer a great opportunity, and to me that should have a significant part in your portfolio. Besides having investments in debt, real estate, you may have a diversifier in the form of a gold investment, commodities, whatever. Go with your asset allocation, but I really think that planning it well. And one final thing is that instead of trying to time the market, I think your money spending more time in the market is going to make the biggest difference. So patience is going to be the key. Volatility is a very obvious factor we are all going to encounter. But if you're patient enough, I think you could really create long-term wealth in the Indian capital markets today. So with that, Pavanji, let me hand it back to you, Mr. Agarwal, to you in case and for you to take this forward, please. Thank you very much. So you're on mute.
Thank you very much, Mohitji. Given very useful lessons, at least for the beginners. Start early, invest regularly, review periodically, look after your diversification, plan well. So I think it sets the right tone for the deliberations to follow. So thank you very much for your very well articulated inaugural address. Thanks. May I now request Mr. Alok Singh, our panelist, to please express his views. Over to you, Alok.
Thank you, Agarwalji, and thank you, corporate professionals, for inviting us. As we have been talking for as we started that long-term investing as what the topic is also, and the allocation and reviewing and things like that. But it is also important that you need to have your expectations right. While you are investing in something, and if the expectations about what you can earn or what the portfolio can deliver, I think if those are not right, then there is a mismatch in terms of you know patience to hold in terms of the long term investing, and also disappointment in terms of adding on to it happens. So it is very, very important. And if I talk of from the equity markets point of view, because if you look at in Indian context, equity market is the only is one of the place where you can beat inflation successfully. In fact, if you can allow me to have a screen share, I can put some PPT over there with depicting that, and that could be easily deciphered by the participants. But to say that, say for example, if I look at last 30 years, the inflation in India has been around 7 quarter. Whereas if I look at the world at the same time, the average has been around 4.5%. This is, I'm talking of global world. The developed world has been around 2.5%. Whereas if we look at the CAGR for our equity markets have been over 13%, 13.5%, if I look at from 1990s. Now, if you, just as. So if we look at from the point of view of why this 13%, why not say 13-14%, why not higher, then you have to look at how our the earnings have been actually, because when you are investing in a company, or you are whether directly or through a mutual fund route or any other, you are participating in the underlying growth which the fund is or the share, the stock is generating. So if you look at for the same period when the equity market, I'm talking of Nifty 50, has delivered something around about 14%. If we look at the underlying ROE growth rate, or look at the EPS growth rate, it also has been around same, around 14% odd. So basically, it means is that ultimately the underlying growth of the vehicle can be matching with where it is coming from. So basically, if you're owning shares of a company, as much as the EPS or the earnings of that company grows, ultimately the share price will catch up to that, right? And that is where it is important to have the expectations right. In the short term, yes, people like to have double, triple, multi-baggers and all that, but when we talk of the long-term investing, it is important to note that if you are riding a vehicle by being a part, in this context, if you are owning a part of the business by being a shareholder, in the long term, that is what you can get. And if you have that expectations right, then you will have longer patience, right? And at the same time, if you look at individual companies get their growth rate from what's happening around in the economy. So then it becomes important to have how the GDP or the global GDP works, and that context sets how much the company will earn. So I think from that is how it should go around, and that's how, if you look at from the Indian context, if you look at our nominal GDP growth rates have been around 13-14%, and that's what had been our ROE or the EPS growth on aggregate basis, and that is what our stock market has delivered. So I think that is how one should look at it, but that has been sufficient enough to outperform the inflation, which is the important objective of investing, so to say. And so I
Alokji,
think
I'm
that's where
intervening.
one should look at it.
You may start your screen share. You've been allowed to share screen if you wish to.
Oh, okay.
Just to
That's
click.
thank you very
your
much.
Screen. Yeah.
Yes. Yeah. Is it visible?
Not yet.
Not yet.
Yes.
Is it visible now?
Yes.
Yeah.
Yes.
So basically, this is what, if you look at, this is what I was talking of. If you look at, last 30 years, the CAGR of market has been around 13.4. Now, if I look at in the context of, that same is the ROE, or the EPS growth, which the market has seen, which is around, 14-15%. So basically, everyone looks at the outcome, which is the stock market performance. It has done this, it has done that. But if you, go bottoms up, if you start coming from the output inward, that what has resulted it. So that's where you see, that the vehicle has delivered as much as what the ROE has delivered, and that's what I think is the important aspects in terms of having the expectations right. And if I look at from the GDP point of view, that is also, because an economy is a larger set, then the companies are a smaller subset. So our economy has done a particular growth rate. I think that's where I want to lay emphasis, and that is what will also lay the foundation of what is that we can expect going forward. Because many a times when we talk of historical statistics, people or the investor will ask, okay, this is past, but what is that I can expect going forward? What is that I can make? And especially with the index at 19,500, which is lifetime high, people are asking that. But if you look at in the granular manner, then we saw 18,800 roughly 2 years back. In October of 21, we are sitting in July of 23. So 3 months will complete 2 years. So from that point, we have just done, so to say, 6-7%. But if I look at from the point of view of EPS, the EPS growth has been much faster. And now going forward, if you look at, this is the chart, if you look at, India is one of the major economies to grow, and this is the IMF projections, where India, they are placing at 5.9%, right? Versus RBI was talking of 6.5%. So this is it's a much faster growth rate versus the next best is China, which is at 5.2. But I think that's where the growth will be driven. But then the question comes is that India has been growing quite fast for a pretty long period of time. What is that it has changed now, so that the people have started talking about it, and so if you look at this, and there where the answer lies, this as of last year, the global GDP was $101 trillion. out of which US, China, US was 25, China was 17, sorry. And now if I look at going forward, the global GDP is expected to grow at 2.6%. Now, if you look at, India's contribution to that would be 8% versus 3% share in the global GDP. So India's allocation towards or contribution towards global growth is increasing, and that is what is changing now, and it has not changed. So we had growth, but we were a tiny economy, so we were not relevant. If you look at China, despite being not so growing, not doing so well, still is contributing a lion share to the global GDP. I think that is what has changed for India. That with you becoming over $3 trillion economy, your contribution is still growing, contribution has increased. And I think that there where, the growth and the return will come, which will translate to earnings to the corporates, and that will translate to our share price. And, if you look at, just before I conclude, if you look at this chart, this is the India's forward premium. While we may say all of it is statistics, if you look at the forward premium, which used to trade around 8% on INR for 10 years back, today that has shrunk to 2%. Obviously, there is addition, the way we have managed inflation, because, and that's where the differential between the US inflation and our inflation has shrunk. That has led to it, and the growth. But I think that is what is telling the story that India is being looked at in a different lens, primarily because of the way our economy has shaped up. Lastly, before I end, as we've been talking about, the patience is the key. So if you look at, you have to remain invested. So, if you look at stock market has a habit of, generating humongous amount of return in a very short period of time. So if you look at, there are three periods which I have mentioned, if you would have missed those three, your return would have been below FD, right? Despite you been investing. So your CAGR from 13% shrunk to, as low as 5.5%, which is not even meeting FD, especially if you have been not patient about it. So my point is that you have to be patient. You have to be in the right vehicle. And I think India as a large is a right vehicle right now. And that's what will deliver return. So if India does not deliver the return, obviously the corporate earnings will not be as high. And I think that's what I ended here. And back to you, Mr. Agarwal.
Thank you very much. Hello.
Yeah.
I think you very rightly put that you must have your expectations right. And this is a great time as the Indian economy is growing. The corporates will also grow and catch up and beat. Thank you very much. Now, may I request Arun Malhotra ji to please take over and share your views. Arun ji.
Yes, good evening, everybody. Thank you, Pawan ji, for organizing this. Thank you, esteemed speakers. It's a privilege to address this esteemed audience. For me, Mohit touched upon asset allocation. Pawan ji touched upon a lot of behavioral issues. I have been a pure equity investor. For me, the 100% equity asset allocation. So for me, there is no debt, 100% allocated to equities. My experience has been, and I would touch upon few points, which concern long-term investing, which concern how the returns are generated. To me, equity markets are the best asset class. First of all, they provide you liquidity. They are fairly liquid. And as my previous speaker mentioned, if you see the historic returns, If you just stay invested, the returns are 13%, which far exceed the debt returns, the gold, the real estate. And real estate, mind you, there was a sweet spot in 80s, 90s, but now the markets have become matured. The rental yields and maybe the both for residential and commercial are anywhere between 2.5% to 5%. This is pre-tax, and these are taxed at 30%. So tax-wise also they are inefficient. And the flexibility and liquidity. If you see from the flexibility and liquidity point of view, an equity asset is encashable on a T+2 basis. So if you sell it on Monday, you can encash it, you get your money in your bank on Wednesday. So there is a big amount of liquidity and flexibility to encash your assets, which is not there in any of the assets. So I touched upon the performance. In terms of what to invest, where to invest, I think at least my experience reflects that I have been sticking to quality investing. When everybody talks of quality, what does quality mean? Quality in the management. You know, a lot of people would tell me, at least my dad would tell me always, ki beta, if you want to buy a real residential asset or a commercial asset in real estate, look for three factors. One was location, second was location, third was location. Same with equities. If you want to generate returns, look for management quality, management quality, management quality. Management quality will ensure good corporate governance. A good management will ensure sound balance sheet, right amount of leverage in the balance sheet. And also, all this will lead to a superior return profile and earning profile. When I say superior earning profile, we have seen a lot of companies increasing their net profits, but their cash profits are not increasing. So that's what I mean by quality earnings. So as an investor, you have to dig deeper. You have to go down 1, 2, 3, 4 notches down and look for these kind of red flags inside. And when I say quality management, in at least my 30 years, I started my career earlier in 1992. And, you know, experience tells you what not to do. You know, everybody knows the books tell you what to do. But experience, 30 years of experience tells me what not to do. If cash profits are not increasing, if there is no cash flow, only net profit is increasing, if the tax rate is low, these are some of the red flags which do not sound good. And as I said, that's where a good management, a good corporate governance distinguishes itself from an average, corporate governance company. In the long run, if you do a back testing, you would see only such managements, integrate with full of integrity, good corporate governance have delivered consistent returns. There have been a lot of, managements who have gone up, came down the sliding path. So if you're looking for consistency and sustainability of earnings, look for managements who can play like Tendulkar or Virat Kohli, who can be there in the cricket till their age says they will not retire. So they will keep on giving you a consistent performance. So whenever, we run a, SEBI registered portfolio management services, and we tell them, we are looking for Tendulkars, we are looking for Virat Kohlis who can give us consistency. We don't want, a player who hits 5 sixes in the last 5 balls and then I go and bet on him. We want consistent players who can give us a consistent return, which beats the inflation, which beats the, risk-free rate, and which compensates the investor for the right kind of risk which they have taken. What else? I think patience. Pawanji also touched, Mohit also touched on patience. Time in the market rather than timing in the market. I think patience is the key. The greed and fear are two biases which normally individual investors have. There is a WhatsApp university which keeps on going, which will tell you a stock will double in 3 months, double in 1 month. I think these are all noises in the market which an investor has to avoid. Tell me, is there any business which can generate 100% return in 1 month? And if he knows, why would he come and tell you? He would just keep it to himself. He would go leverage somewhere, keep his house and have 2 houses in 1 month. So these are all some of the things which one has to avoid. And common sense, just common sense investing. I'm telling you, it's not complicated science. It's not a rocket science investing. It's just common sense, which is very uncommon with among most of the investors. I'm sorry to say, despite so many knowledge sessions, despite mutual fund doing a great job, but still I see investors doing, or maybe spending a lot of time in speculation, in scripts that do not have balance sheet. They are just looking for quick return. And that's where the significance of this topic, which for this webinar is very critical, investing for long-term wealth creation. This long-term word needs to be underlined. There is no quick mantra in this. Wherever you see some quick mantra, maybe once you will go right, twice you will go right. Third time, when you go wrong, you will be sitting on the maximum risk. एक का दो हुआ, दो का चार हुआ, चार को आपने risk पे लगा दिया. That will come down by 50% or 70%. You will be back to square one. And this is a market where if you go up by 10% and you're down by 10%, you still lose 1%. So you have to make sure that there should not be any drawdowns. There will be drawdowns, but the drawdowns should be very limited. What else? I think noise in the markets I want to touch upon, because there are a lot of noise in the markets, either through TV channels or through WhatsApp or so-called tips. These noises are nothing, just to confuse investors. They are speculative in nature. The retail investors, even the HNI investors, have to avoid it. There are biases, Pawanji also mentioned about behavioral finance. Mohit also touched upon. I think a lot of investors have few biases. I want to address 1, 2, or 3. One is, if let's say I bought something at 100 and the stock price comes down to 60 rupees, if you have not sold, you have not made a loss. Trust me, for an investor, every day his balance sheet is calculated, his P&L is calculated. So there's a mark to market. If the script has fallen from 100 to 60, he has already made a loss. Whether he has not sold it or not sold it doesn't matter at all. So if there is no cost element in it, you have to forget the historic costs. Every day is a price, and you have to think. Similarly, if from 100 you have a doubler, the stock goes to 200. You can't say my cost was historic is 100, so I will keep on holding. You have to think, can I make a return from this 200 rupees? Now your new cost is 200 rupees. So this is one bias I think a lot of investors have. One needs to shed that. Second is anchor bias, herd mentality. A lot of people will buy, keep on following big buyers, but I think they need to do deep research. And there is one more, recency bias or a negativity. A lot of people, they will ascribe more weightage to negative news than positive news. Recency bias. Recent events will have more weightage in your mind. Just analyze, just do some introspection on any day. You will see those events will have more impact on you rather than, you would look, a stock which has given you 20% historic return, CAGR. Something negative happens, you will keep on harping. Sachin Tendulkar, coming back to Tendulkar, he can also get out on a duck on a spinning wicket. So don't extrapolate, So that's what I'm trying to say. And lastly, I want to touch upon volatility. Equities are risk because sometimes they go down, sometimes they go up, while debt market is a smooth line. But you are adequately compensated for that volatility. See the kind of returns which you have made historically. And if you ask me, volatility is the best friend of investors like us. Why? A volatile environment gives me an opportunity to buy the best businesses at discount prices. It's like a premium brand. On a particular day, you were passing through the mall, and you saw a 40% discount and you wanted that t-shirt. So जहाँ वो 5,000 का t-shirt था, you are getting a 40% discount. And the t-shirt, the quality of the everything is the same. So volatility is the best part of these markets, and it gives us that opportunity to buy. I think summing up whatever I said, the equities are the best asset class. Obviously, there is a bias, but I am saying this after 30 years of investing, after tasting success. And once again, it's not a rocket science, just common sense investing. Thank you. Over to you, Mr. Agarwal.
Thank you very much, Arunji. Very well articulated, and the takeaways, as I see, is your emphasis on equity investing, that this is the best asset class because it provides flexibility, very good liquidity vis-a-vis certain other investments like in real estate, etc. I really appreciate your emphasis on quality investing. That is, you just look into the quality of management, the type of good governance, what type of governance practices the company is following, their integrity, their consistency in policies, whether they have a sound balance sheet, the cash flows and the net profits, are they matching? Do they have a superior earning profile? Then you said that timing is the key. You have to be patient. Then, of course, we all know that we cannot speculate on companies. We cannot go on tips. There is no quick mantra. We should not follow the noises in the market. And then you refer to certain biases very nicely, and particularly the recency biases. And lastly, you said volatility is your best friend. That gives you an opportunity to buy the best business at the best price. I think very well said. Before we get into the some questions, Shivam, Mr. Dua has joined. Now I'll start with Alok ji. My query, which we had circulated also, was that how do you identify a sector, and how do you find for long term?
So as I said that in my opening remarks, that everything is you have to look at from the concept of subset. So what is happening globally will have influence on India economy. What's happening in Indian economy will have influence on Indian companies and the businesses here. So basically that's what we call of when we talk of macro trend and drilling down from there. So that is one way to look at and a more holistic way of looking at it. So I think that's where you have to do it, and then you then narrow down on basically, or either I put it very simply, you have to go by the concept of elimination. Like when we go to a doctor, he goes by the concept of elimination, right? Now, every investor and every time you're looking for a new sector, you have to look at, come up with that list and go by the concept of elimination. Now, obviously, to zero down, you can be looking at the macro trends, as what I was saying, which could be happening. Like, for example, if you look at for some time, there is this China plus one theme, which has been propagating quite well, and Indian government is trying to support that with a PLI scheme. So if you look at that, becomes a theme. If you look at recently, we have seen things like semiconductors or robotics. That is what we have been talking about. So those are the macro themes which we are looking at. But at the same time, which is very important, is that while we chase these themes or the story which we are talking about, we also have to be very diligent of the fact is that what is that it is the size in terms of the present size and the future size, because that is what will allow you to have your trade sizing right. Because if it is a very tiny sector, smaller companies, obviously if you go for a very higher allocation, despite it ticking everything right, the risk profile of the portfolio increases quite a lot. So you have to see what is the size of it as an opportunity today and what it could be. That determines. And as I said, that ultimately what you will make as a return is nothing but the CAGR of its EPS or the ROE, typically the way we look at it. So you have to evaluate the business from that perspective, and then combination will give you a smaller set of things, and there where you can do the trade allocation. I think that's how you broadly look at.
Thank you, Lokji. And before I get back to you, I extend a very warm welcome to Lalit Duaji, who has joined us now. May I now request Mr. Lalit Duaji to share his perspectives and his ideas on how to invest for long-term growth. Lalitji.
Thank you very much. Well, as everybody has already elaborated, my investment theme for long term would be corporate governance, and corporate governance. While most of the people consider stock market to be science, it is actually an art. If this would have been science, then everybody has the same numbers. Everybody would have been multiplying EPS into PE ratio, and everybody would have the exact answer. Then there would have been no buy or no sell or no two-way quotes on a particular date at a particular moment, because everybody has the same statistics. Since everybody perceives the same company, the same set of numbers in a different way, that is why I believe stock market is always an art. And we should look at variety of parameters. That includes how the balance sheet has been presented, what is the focus of the promoters, what is the entry barrier, what is the technology, what is the corporate governance, what promoters have done in the past, what they intend to do in the future, how much their focus in on a particular field, what has been their market share in their fields, and so henceforth. So it is very difficult to enumerate one particular thing, that how that should be looked in stock market, on what should be a particular criteria. So stock market is based upon sentiments, emotions, and so is the stock selection and stock picking theme. So if anybody asks me what do you look at, it is variety of factors. It is the quality of the balance sheet, how much taxes the company has been paying, what the company has been paying as dividends, what they are doing with internal accruals, how the promoters capital has been built up, and how much frequently they come to the capital market so as to raise funds, what has been their consistency, what has been their ROE, what has been their RONW, what has been their PAT margins, what has been their market share. So lot many factors we look towards while deciding, and it is also based upon intuition, it is based upon gut feel, it is based upon I would say hunch. So these are variety of factors that at least we look in if we are making a long-term investment. If we are doing some kind of trading or we are doing some short-term investments, then the parameters could be different. As the answer, if you have to play a spin ball, or you have to play a fast ball, or you have to hook a shot, or you have to just play through it as a defensive. So there are various parameters and there are various strategies. But if somebody has to hold a stock for a long time, even though it could be held for a shorter period of time because your target could have been achieved earlier, or you may change your mind subsequently because the first initial afterthought process that you may have thought on while deciding a stock may change as the stock market itself and the technology itself is a very fast changing process. And so sometimes is your mindset about the promoters, so that also keep changing depending upon the sentiment and emotions. So it is very difficult to pin down one particular theme or one particular strategy or one particular factor that should be followed, but there are multiple reasons, multiple strategies, multiple things that should be kept into mind while doing this. And I think this is my take for investment, and this is all I wanted to say. In case somebody has any questions, I would be more than happy to answer it.
Thank you. Thank you, Lalitji. Lalitji, we were talking about how to identify a sector or industry for long-term investing. What are your views and guidance?
There is no particular formula, or there is no particular, if this would have been any scripted theme, then it would have become a science. So it is also based upon your hunch feeling, and I have a right to be wrong, and many of times we go wrong. But in stock market, it is not the number of times you are right, how much you have held upon to the winning bet. In the game of casino, if we spin the coin 10 times or 20 times, the probability of head and tails coming is both 50-50. But in stock market, even if the losing bets are 60%, 70%, 80%, if your capital is wiped off even in the losing bets, and your winning bet is only 20%, but if you have made them super multi-baggers, for example, for 10 rupee that you have invested into one particular company, the maximum that you can lose is 10 rupees. So for a 100 rupee bet that you have made in 10 companies for 10 rupees each, even if you lose 100% of your capital in 8 companies, the maximum that you have lost is 80 rupees. But if you make 500 rupees or 400 rupees or 300 rupees in the 2 companies in which you invested 10 rupees, still you have done your job well better. So that applies the same for identifying any particular sector or industry. Many a times it works both ways, as a Hindi में कहते हैं दो धारी तलवार, or a double-edged sword in English. Sometimes we identify a sunrise sector, which is actually a sunrise sector, but as any industry faces hiccups initially, sometimes we are ahead of the curve of what happened in renewable energy earlier, or what happened in solar energy earlier, or what happened in wind power earlier, or many a times even telecommunications earlier. So while these sectors proved out to be extremely good, but sometimes if you are ahead of the curve, for example, in 99-2000, while people were able to identify the dot-com sector very early, initially the the valuations immediately went up the roof and then crashed. So sometimes you should not be even unlucky so as to identify a sector too much earlier, because initially the technology also takes time so as to establish itself and work out itself. So it is all based upon hunch feeling, gut feel, but we keep on looking towards what are the sunrise sectors, which sectors has potential, which sector the market has not taken into account, and at any moment of time, at various times, like the solar power, like the wind power, like the EV, the electric, or the computers or the software, these were the sectors some moment of time which were the sunrise sectors initially, and if anybody would have invested in them at the right moment in the right companies, I think they would have made a lot of money.
Thank you. Thank you. Arunji, how you have been a very long-term investor. How do you identify sectors in which you pick up companies?
Sir, we, as we are mainly a bottoms-up approach we follow. We would look for stocks where there is a disconnect between the value what we are getting and the price what we are paying across sectors. But you see,
That is about the company. So I would also love to know about how an
yeah, so
industry.
so Lalit, I am coming to you.
Yes,
So
yes,
in
yes.
sectors, lot of times it is very easy when there is a clear roadmap. I will give you certain examples, especially commodities. When we in telecom also, telecom used to be a commodity earlier when it was in distress, when the call rates were 16 or when there were 16 players and number of players came down from 16 to 3. So that, and even Jio was always making losses. Bharti was also making losses. So that was the turning point when we see is when all the companies in a particular sector are making losses, their balance sheets are in red, and now number of players have reduced while the demand continues to increase. That's the point when we identify sectors. Similarly, in case of sugar, in case of steel, aluminum, steel, if you go back to 2017-18, all the companies were making losses. So it's such an easy roadmap for you to just identify the player that will survive the crisis. Even though Tata Steel was making losses, you just pick the best company, which is the most cost efficient. Pick that company, pick that sector first, where everybody is making losses. We call it distress. Pick the company which will survive the downturn, and pick the lowest cost efficient. Most cost efficient, lowest cost producer, and you will ride. Just remember, Tata Steel did a big acquisition. They were able to recover all the cost within 1.5 years. Lot of mid-sized steel companies like Sharda Energy, Godavari, who were bankrupt, who were defaulting in 2017-18, are their current EBITDA is twice the market cap of that company. So for us, such situations do arise every 3, 4, 5 years. Same situation happened post DHFL crisis and ILFS crisis when most of the NBFCs were available at 0.4, 0.5 times. PSU banks were available at 0.3, 0.4 times. And then the government came with restructuring of the banks and merger of the banks, making them bigger. And you see the stock price. So a lot of times what we look for is regulatory changes, what is happening in the sector where there is a distress. Same happened with IT, this everybody's talking of AI, machine learning. So you could identify those themes and work around those and pick the best player and just sit tight, sit quietly for long term. I hope that does answer some of the questions.
Sir, as we keep on learning always from you, it is always a wonderful experience for us to listen to you. And as much as we know that you would always be a wonderful champion in answering, still it is our endeavor to next time listen to you once again.
My pleasure, Lalitji, my pleasure.
See, all of you have put a lot of emphasis on corporate governance. You said corporate governance.
For long-term investing, yes. But if we are trying to play some kind of a momentum trade, or if we believe that the markets would be able to think the way we are thinking in the short term, and sometimes there are some stories which may not be perfect in the long term, but it could be a perfect trading play, then we have to look the other way sometimes. But if you are exactly asking that, okay, whether this stock can be held for 5, 7, 10 years, then I think if you ask me what are the other parameters, then I would put corporate governance on the top.
Right. My question to Alokji, Alokji, qualitative analysis do you carry out while making investments? Please unmute yourselves.
Sorry. So the first and foremost for any minority shareholder to make money is that the business should be making money, or business should be expected to make money. So I think eye on the positive cash flows, if not immediately, but in near future, not in very far future. I think that's very, very important. Because without that, neither the business will be sustainable nor the business can be valued for a very long period of time. So, the first and foremost is that yes, the company may be loss making today, but even if it is, then it should be making money in near future, not very far future. I think that's where the starting point is, whether you look at individual companies or individual sectors. And secondly, while we are I have heard other members talking about corporate governance, business. Ultimately, you have to appreciate one thing, that we are a minority shareholder. We only know what the promoter or the management tell us. No matter how much you think that you know, but you know only what they wish to tell. Now, if you look at, there are many management who come forth very constructively. They will disclose, they will make all those disclosures and things like that. But, are they always complete? I really don't know. Are they, to help us? No, it is not to help us. It is just the, so to say, the anxiety management, so that, when things happen, that things have been, it is going to be bad. And so I come beforehand and I do the shock management. So basically, the point I'm trying to make across here is that if you if you keep in your head that you are a minority shareholder, you are here for a long period of time, but you are not an eternal owner of this business. I think there where you start, whether you are doing trading or you are doing long-term investing, the fundamentals are right. And you have to look at things in the context, right? While it is very easy to say, okay, if you look at, there are value investing where you only look at discount. There are growth investing, which is always growth. But if you look at your money is available with you for always, right? So, while it is very easy to say that, okay, if there is no value or if there is no sale happening in the market, I will not buy. It's very human that you will still buy. So, you have to do the things which are relevant and not be married to the fact that, I will only do this particular kind of a thing. And that's why, we say that if you can't do it full time, you outsource it. And that's where the, anybody who give money to any professional, whether it is coming through PMS, AIF, or a mutual fund route, I think that's where this particular things comes in. So I think most important is as I said, coming back is to look at cash flows. Business prospects, we can only make guesstimates about it, because there is, only the time will tell whether this works or not. So you have to be regularly evaluating it. And, when you are investing, basically there has to be a monitorable thing, which in your hypothesis, though that could be qualitative, it may not be quantitative always, it can be qualitative, but there is few monitorables which you are looking at, and that is why you are owning that business. So, if those things are not tracking well, which means there is something wrong in your hypothesis, right? Like if I look at, there are many times where, what happens is that, you buy a stock after all your research and, the stock is down 20% from there. People say that, okay, you have bought it at 100, now it's available at 80, you should average, you are ready to buy at 100 and now it is 80. But the fact is that, maybe you have misjudged it at 100. You never analyzed it, or you have overpaid, right? So, that does not mean that, if the price has corrected, you just jump in. You have to reassess, relook at your hypothesis, whether it is still right. have you overlooked something? Because when you bought it at 100, in your wisdom, you did all the right work, right? And despite that, and you bought it to go to 120, not 80, right? But it has gone to 80. That means you are wrong somewhere. So that humility should be there in the market. If you don't have humility in investing, you will not be able to sustain for a long period of time. You will continue to do mistakes. So basically, one is the part that while we will make all guesstimates in analyzing right from the fundamentals, like whether cash flows, ROEs, business potential, and things like that, but also there has to be a humility to accept that it has gone wrong, right? And that's why the trade sizing comes in picture, that you have to size the trade right. I've heard many people looking at, they feel very very excited when they identify a right stock and they buy, and they'll say, oh, I bought it at 100, it's trading at 500. But the question is, did you buy it in the right size? That's what important is. If you have, yes, if it is 25 basis point of your portfolio, while it may have become 100 to 500, it will not add any value. So the trade sizing is also important from the point of the risk management, right? That, what is that you allocate, where do you allocate? While, if you are doing it on a trading basis, it's a separate thing, that's a different thing. But, if you are talking of investing and you are, this is not your bread and butter, you are doing something else, and then, there are surpluses which you are generating and getting investing. I think there where the difference lies. So I think, to me, first is the sustainability of the business. And second is that, being humbled and say that, boss, I know only as much as what is available in the public domain. There are people who knows more. So let me not try to be over enthusiastic about it. And that helps, that is what it leads to the trade sizing, that, what kind of risk which I can take as a percentage of my portfolio, so that even if I go wrong, I still remain relevant. So I think remaining relevant is important, and I think there where it flows down to.
Thank you. Thank you. Arunji, that takes us to the question of, in long-term investing, how do you manage risk? How do you avoid pitfalls?
I think Alokji did mention about sizing of the position. That is one way to reduce risk. The second is the diversification. You diversify your portfolio across sectors, but over diversification also leads to higher risk. So the diversification has to be appropriate. And maybe a portfolio should not consist of 50 stocks, maybe 15, 17, 18, 20. Because if there are more stocks in a portfolio, very difficult to monitor, very difficult to generate alpha. So diversification is one way. Second is sizing. I think there is one more, which I think Lalit ji is an expert, as Pawan ji said. He is an expert in all that. We also do some portion, a big portion of our portfolio in special situation investing. In this special situation, we just monitor the corporate events. And trust me, we are, as Alokji said, it's very difficult to project the estimates, project the earnings in the future. This special situation investing, part of alternative investments, does not take into account the operations, the business operations of the company. It is just focus on if it is a buyback, if it is a delisting, if it is a merger, you are basically focusing on the corporate event. And hence, if you invest some portion of your portfolio in these kind of situations, you could actually reduce the risk of your portfolio. And these situations, these stocks, these situations, in fact, give you a much higher return than a pure vanilla portfolio with reduced risk. Coming also, I want to touch upon the minority investor concept. We have been actually, even though we always consider ourselves as a minority investor, but we always try to make our voices heard in the boardroom by writing letters. There are activists in the US. Those take big positions, try to influence board decisions. But we as minority investor, if the management is not doing, or they strategically they should be doing something else, or there is something lacking, we do write letters to the management, to the board, raising our issues, raising our concerns, so that can be addressed appropriately. So that is one aspect. We also try to make sure that, and also I want to touch upon, if the stock falls down, people think risk is higher. This is a very common concept among investors that, 100 ka 80 ho gaya, 70 ho gaya, the risk is increased. So what we normally do in those situations, we will go back to our drawing board. We will test the assumptions. Has this price happened because of company specific factors, or is it because of external factors? If it is company specific factors, that means our analysis, our thesis has gone wrong. You need to exit, whatever may be the price. And we do go wrong. Everybody goes wrong. If it is because of the external factors which has changed and which has now impacting the company, which changes our assumptions, there will be a new price in our model, and then we need to act accordingly. And lastly, if there is no impact, it is just the volatility, coming back to my original point, just the external factors, while the business is intact, maybe just a minor hit and the price has fallen much more than the impact. For us, if the price falls down, that volatility, we will be very opportunistic. We will actually increase our position. We will increase and we will buy more. I hope that does clarify a few things.
Certainly, a few things. Lalitji, these days, you get a lot of advisories from proxy advisories. Now, proxy advisories, how much weightage do you give while investing to the advisories given by proxy advisory firms?
No, I don't think the proxy advisory give any buy recommendation. Sometimes they give any recommendation based upon any corporate event. So, as Arunji, my co-panelist and my good friend has mentioned, that we do a lot of special situations which we believe we do better than value investing. So I would be not in a position to comment as much as on value investing as compared to special situations, which we believe we do slightly better than anything else. So in the case of proxy advisories, if any corporate event has happened, they give their own advice. But we are not buying, or nobody is buying for that event. They would have already been invested into the event, and they would give their suggestion whether the investors have to vote in their favor or against it, or whether any action is in the interest or against the interest of the minority shareholders, any acquisition, any preferential allotment, XYZ. So most of our actions are based upon, I would say, corporate actions or special situations, which is merger arbitrage, demerger arbitrage, delisting, open offer, partly paid up shares to fully paid up shares, convertibles arbitrage, etc., etc. So we would only go by what is the corporate action and what is our internal drawing board thesis on that. And if we believe that our earlier action was right, and if the price has subsequently fallen more, so instead of making a stop loss or instead of panicking, we would rather love to buy more if our initial thesis has been right. Because as Arunji rightly said, at the end of the day, beyond a point, it is not based upon earnings per share or PE ratio or what would be the market capitalization. If it is a pure corporate, even action-based arbitrage, for example, if we are assuming that all our shares will get accepted in the open offer, or if it is X to Y merger arbitrage, whereby both the shares are listed in the F&O, then the only thesis would be whether the merger will finally see the light of the day and how long it will take for all the clearances to come, or if it is a demerger arbitrage, then we have to take a call. If both the companies are listed in the futures, or one of the companies is listed in the futures, or both the companies are not listed, then what would be the sum total of both the companies? And similarly, if it's a delisting play, then whether the acquirer will be willing to accept all these shares, and whether the book will be built or not. So and so on. So we would not give a lot of importance while initially taking a decision whether any proxy advisory has given anything or not. But yes, if we are subsequently invested and if something comes, we would of course like to read that report in detail. And most of the, in fact, all the reports that have been given by the proxy advisory are very interesting to read, because they come with a lot of research, lot of efforts, and they advise the minority shareholders that what should be their decisions. And I have rarely come across any proxy advisory report where I tend to disagree with them. So yes, they are working in the interest of minority shareholders, and a lot of weightage I give to those reports once they have subsequently come. But my decisions of investing or not investing is not initially based upon them, because either we would be invested in those companies or we would not.
Thank you. Thank you.
Agarwal ji,
Yes, Paul.
I have a question to Arun and Lalit, because they are doing a special situation investment. Do you think in India, like Alok ji will be agreeing with me, there is no mutual fund doing a special situation investment?
There are a lot of PMS, and there are a lot of arbitrage funds, but there is no particular, because this event is not that big. Because if a mutual fund goes and then raise funds, then they get sizable funds. But that industry or that action is not an everyday event. There may be an open offer arbitrage, there may not be an open offer arbitrage. Sometimes the open offer prices could be higher than sometimes the market prices could be higher than the open offer prices. Sometimes the open offer size itself is too small, and even the open offer size is there, the floating stock could be very less. So this industry is not a big industry. It could be good for any PMS having 3, 4, 500, 1,000 crore rupees, but this is not a $1 billion or $10 billion whereby the SIPs can keep on coming, and it could be an open-ended or closed-ended scheme. Also, Pavanji, I would take to have one more question, and then I have another conference, so I have to go there. And right now there are a lot of traffic jams because of heavy flooding in Delhi. So may I have
Not heavy traffic jam, it's a heavy flooding.
Yes.
And I'm in Bombay, that's why. And Bombay is popular, but Bombay is clean today.
Yes, you are lucky today, but unfortunately, it is very unfortunate that because of this heavy rainfall and because of this opening of the floodgates of the dam of right now, there is a lot of water logging in many parts of Delhi.
Yeah, Lalitji, you were saying something.
So I said that I can have a liberty of one more question, and then unfortunately I have to leave this wonderful discussion.
Okay, then if you are leaving, then I have one question, very interesting question, and Arun will agree with me.
Please.
What is the success of your knowledge, because you are working in knowledge industry? Okay, knowledge industry of the capital market. So please give tips to everybody. So because you are, no doubt, you are one of the successful and admirable investor in the market related to this. So we all want to understand your success tip to everybody.
Well, I don't have any formula, except that, as my fellow panelists said, first of all, you have to be humble. This is one. And in my case, I believe I'm extremely lucky. I was blessed. I was at the right time, at the right place. And maybe God was extremely kind, and it gave me some kind of blessings so as to get my path right. As Warren Buffett would have said, that if he would not have been born in America, and at the same time when America just started to grow, if he would have been born in Sudan, Nigeria, or any other place, or even in America, but not at that time, maybe he would not so much here. So I believe a lot of importance to luck and being at the right place at the right time. and the blessings of God so as to give your path correct. So I think that is what I believe. Whatever little or big I have done, that is the fundamental root cause of where I am.
Okay, okay. Arun, you were asking some question
I
from.
have your permission, sir. I have to leave, sir. Thank you very much.
Thank you, Lalitji.
Thank
Thank
you.
you. So Alokji, Lalit has just mentioned
Yeah.
that this is not a big industry or special situation, and which is coming out very well because today, whenever you are talking to somebody, they are talking about this investment opportunity. So, as a mutual fund, what is your view?
Pawanji, the thing is that, we are a economy which is aspiring to grow fast and become a developed economy. So is the everyone associated with that, right? So while and that's why, basically such kind of investing or the pool of capital required a different type of understanding and different kind of patience. Like if you look at, we have seen what Arunji was mentioning, that we write to the managements and all that. There are active investors and all that. But if you look at the active investors, there is a long fight which happens, right? If we have seen companies getting transformed, broken up, but look at the way those investors have fought, put in a lot of money behind, and all those kind of a thing. So that needs a lot of patience, and that is something which is missing right now. If you look at the average life of investors in mutual fund is just 2 years, right? It is not beyond that. So the patience and rightly so, because as a country, we are trying to be rich by investing right now, right? Everyone wants to be rich. Who has one wants to make it 10, right? And it is true, whether I have 1 lakh or I have 100 crores. And everyone wants to be rich by investing, and then because of that, the pool of capitals which all of us sit is very impatient. There could be very small pool which can be there for a long term and which people understand, they be sophisticated, but majority of us want to be rich by investing, and that is where the problem is. But that is a phase. As we become a more prosperous country, as we have more capital and we have more resources, there will be need for that. Like today we have been talking about beating inflation and all those kind of a thing. There are hardly handful of investors who will give you a mandate saying that I just want to be beating inflation, just keep this safe, right? I don't want this money to grow, just keep the value intact. But in the developed world, you will find mandates like that where the investor will tell you that I just want this to be preserved. So basically, which means just beat the inflation and I'm happy with it. So I think we are moving from that phase right now, that we are impatient with it. But I think soon the time will come that we will have that kind of pool of capital, and probably all set of vehicles, including mutual funds or AIFs or this thing will have those things. Pawanji, you're on mute. Sorry, Pawanji, so you're on mute.
Okay. So Arun, because now we are at the end of the webinar, and you have given so many good things also, and so many style, but everybody has given their own way of investing. But what is the problem with the investor when they are doing and they are thinking that this is right approach, but what is the reason that they come under the influence of manipulator, hearsay, and various other aspects?
I think very simple, Pawanji. Everybody is greedy. That's a human nature. If you see, human nature is greedy. But greedy to what extent? You want to double your money in 1 month, in few weeks, in 3 months? Do you think is that possible? And second is the fear. As if you have bought a good quality company, the stock price falls, there's a fear in the mind. It might come down to zero. If you have done your homework, if you have the conviction, so first step is do your homework. If you cannot do it, give it to a professional manager. Maybe a mutual fund, maybe an AIF, maybe a PMS. And if you have done your homework, then there is no need to fear. And fear is, fear drives what it drives. In COVID, as soon as the market starts coming down, everybody says this is the end of the world. Even if, let's say, the company's value, true value is, let's say 100 rupees. The near-term earning of their company, let's say 12 months earning, is only 2-3% of the overall valuation of the company. So even if the companies do not perform in the next 12 months, maybe 5%, 7%, 10% max, depending upon the quantum of loss, that could impact the overall valuations. Businesses don't die. They probably will stop, they will probably refigure and then come back. And that's why we said we need to find Tendulkars, Virat Kohlis who are consistent, who have the natural skill, and where there is good corporate governance, so that in good times, those managements will share the benefits with you. In bad times, you have to stand with them. It's not that, a lot of times when the markets are bad, people will just keep on selling. That's a behavioral bias. That's a wrong behavior on the parts of the investors. And if they just stay invested in good quality companies, I think they can reap the returns.
Okay. So, Agrawalji, any other thing, any other point you want to ask? Agrawalji, you have to unmute yourself. You have to unmute, sir.
Most of,
Agrawalji, you have to unmute.
yes. Hello.
Yeah.
Can you
please.
hear me?
Please.
I think we threw the questions.
Okay.
You will like to conclude now?
Okay. So I think Arun, Alokji, Mohit and Lalitwa, these are the 4 stalwarts of market. And interestingly, 2 is from the mutual fund industry, 1 is from PMS, and 1 is from special situation. It's exclusively doing special situation fund investing. So no doubt we got a clear-cut message to all. One message is clear from everybody, that if you want to be long-term investor, or if you want to earn in the stock market, you have to think long-term horizon. Second is, it is not bad that short-term investment you can't earn, but that is not your cup of tea. You have to just understand, if you have this knowledge, so you should work on the basis of your knowledge. And I think the knowledge which they are telling, do research, understand, and then invest, and invest for long term. Market will not go down, in the sense, market will go down temporarily, will go up. If you see the index of since 1971, and then you can see that no doubt market has gone up, down, but one layer is always on a higher side, that is going up. So if that is taking place, so what I'm got the message from all the learned speaker, that have patience, invest in good company, and good company's analysis is not only the bottom line or top line, it's a quality of management. If the quality of management is good, they will make money for themselves also, they will make money for investor also. I think with these things as a ritual, now only Arun and Alokji is there. Just in 1 minute, you summarize what we have, what is your message to the community, investor community. First, I'll request Alokji. You just tell what is the message of all your message, all your discussion to the investors.
Sir, my message is very simple. It's been echoed again and again in this forum that you have to look beyond the noise which is there. If the things were so simple, everyone would have been able to do, right? So, don't go by the hearsay and all that. Have patience and believe that, as I started my remark, that if we look at as an Indian investor, so if India does well, every company as part of it will do well, and our investment will also do well. Yes, there will be phases where my boat is rowing a bit slower than others, right? But those phases happens. But end of the day, it catches up. The law of averages catches up. The all of what you have to ensure that your boat does not have a hole. So your concentration should be to see that your boat does not have a hole, right? And it's moving in the right direction. You're not moving in the opposite direction. So direction and hole is what you have to keep on finding in your portfolios and weeding out that, and rest all will be taken care by the macro thing which is happening around us.
Okay. Arun.
Yeah, I think the key message which I want to deliver is equity is the best asset class that will deliver the best risk-adjusted returns to the investors. Be patient. Don't fall to the prey of greed and fear. It will create a long-term wealth for you, your family, and your kids.
Okay. So, thank you very much, Arun. Thank you very much, Alok. And Mohitji and Lalit Dua, they have in their absence. I'm so grateful. I'm grateful to all my participants that they have come in and attended this program. Friends, thank you all. And this journey of knowledge sharing will continue. And with each program, when we are adding number, it is giving encouragement to us to do more or better program. We are working out that how we can make more interactive program and what is the need of the industry. So that's why the next webinar we are organizing on family trust. And this is a route for useful for all, an effective tool for succession planning. And this is a need of our for all investors, all person, all industry, all management, and all high net worth client. We will discuss this issue. We are calling expert from the law point of view of taxation, law point of view of listed company point of view, because when you make the trust and transfer the listed company shares, you have to take some specific approval from SEBI and you have to take exemption from takeover code. So with these things, next week, same time, 4 o'clock, we'll meet. And thank you very much to all. Today is a very auspicious day for us. We have started a Bombay office and we'll do more service to the industry and the more service to the profession. Thank you very much.
Thank you.